In this video, I'm going to talk about a very important subject that many traders end up ignoring. Part of being a disciplined trader is to be able to create and follow a solid trade plan. The often ignored part of that plan is actually what markets you are going to analyze on a daily basis. There are many financial instruments, and the amount of opportunities in each one of them is massive. That does not mean a trader will be able to keep track of most of these opportunities. In fact, trying to keep track of too many markets at once can be highly counterproductive, and there is a very simple reason for that. If you try to analyze too many things at once, you will not be able to reach the necessary depth of analysis to trade effectively. As you might have experienced for yourself already, contextual trading is not exactly easy, and it takes quite a bit of mental energy to reach the final conclusions before pulling the trigger for a high-quality trade. If you try to apply this level of analysis in many different markets at the same time, you simply will not be able to do it effectively in any of these markets. The reason traders tend to look at too many markets at once is the fear of losing good opportunities. This tends to backfire because looking at too many markets will prevent you from reaching a high-resolution view of any of these markets, and consequently, you will miss most of the opportunities. The antidote to that problem is keeping track of one market or maybe two. That way you can really get in sync with whatever is happening in your market of choice, and you can increase your depth of analysis to a degree that is just above the threshold for creating high-quality contextual analysis. If you do that, you will notice that your mind will be a lot clearer because you will not be bombarded with too much market information. You will still feel like you are missing all these opportunities in the other markets, which is true, but at least you will be a lot more capable of taking the opportunities of one market, which should be more than enough for you to trade consistently in the long term. You basically have two options. You can apply a low-resolution analysis to many different markets and miss the really good opportunities you should be taking, or you can apply a high-resolution analysis to one market, take the high-quality opportunities it will appear and just forget about the stuff you cannot reach anyway. Let me expand more on this idea of low and high-resolution analysis and why this concept is important. A low-resolution analysis of something is enough for you to understand the surface of that something, but it's not enough to constrain that something within the realm of practicality. A high-resolution analysis is exactly the opposite. Let me give you a very simple example of what that means. Imagine a drawing from a helicopter. When you see the drawing, you can immediately understand that this is a helicopter. However, the level of detail in the drawing is just miles away from a real helicopter. In other words, everybody understands that this is a helicopter, but nobody expects this helicopter to fly. It's a mere caricature. If you increase the level of resolution, you will get a more detailed drawing. The increase in resolution means that more real details are being taken in consideration, and therefore, the drawing is closer to the real helicopter. Now compare the drawings to an actual helicopter and imagine that you are a mechanic that needs to fix a broken helicopter. Your level of understanding of the real helicopter must be insanely high for you to be able to fix it. In other words, to fix a real helicopter, or at least to understand how it actually works in the smallest details, you need to have an insanely high-resolution understanding of the helicopter and its moving parts. There is an undeniable parallel we can draw from this helicopter example to the life of a trader. When traders look for simple solutions or for that magical setup that no one ever reaches, all they are doing is operate under a very low-resolution analysis of the market. No matter how good you get the low-resolution analysis, you will never reach the necessary level to succeed. The problem here is not how good you are at the analysis. It's the analysis itself. However, if you increase your focus and trade fewer markets, you will be able to increase the level of resolution and you will see opportunities that most traders don't see. Trading too many markets and looking only for setups is a lot like the kid drawing the helicopter and pretending it flies. Trading fewer markets and really focusing on the contextual analysis is a lot like flying the real helicopter. It's a lot harder, but it's the real deal. If you liked this video, don't forget to subscribe to our channel and to leave your feedback below. Thank you for watching.